I'm Ben Carbonneau. I'm a senior analyst at TBR, and I am in our IT infrastructure and devices practice. But I also look at the market of channel partners or value-added resellers, and kind of follow how hardware goes through the channel. So I'll be looking at today's managed services discussion through more of a hardware lens, focusing on the OEM and the VAR perspective.
Great. Hi, everybody. This is Alex Camille. I'm a senior analyst in our cloud and software applications practice. I also co-author reports on the cloud ecosystem, everything from SaaS providers up to the hyperscalers, with my colleague Boz Histrov on professional services. So showing the line between cloud, hyperscaler, and the professional services landscape is something that I'm thinking about a lot, and looking forward to talking about managed services environment with you today.
Excellent. And I'm Patrick Heffernan. I run the professional services and IT services practice. And for me, that means covering companies that range from McKinsey on one end of the spectrum to Wipro on the other end of the spectrum, and kind of everybody in between. So we're going to be talking about the managed services components of those kinds of companies, in particular how they overlap or maybe don't overlap with the companies that Ben and Alex cover as well. So what are we talking about when we say managed services? When we say managed services, everyone has a different definition, which makes it a little challenging to talk about managed services across multiple parts of the ecosystem. So I'll kind of go first and say, for us in the services space, in the professional services and IT services space, we often think of consulting and services as being one of three things. It's either tell me what to do, help me do it, or do it for me. And managed services is the last of those. It's the do it for me. It's essentially any time that you have a set time frame, an established, agreed commercial arrangement and terms, and it's essentially taking some kind of task that an enterprise simply doesn't want to do, doesn't have the skills to do, or doesn't have the time to do, and doing it for them. It is the do it for me part of the services piece. Of course, it's a lot more nuanced than that. But that's basically where we're coming from in the professional services space when we talk about managed services. Ben, what is managed services for you?
Sure. So I think of managed services being comprised of the outsourced monitoring, management, and updates of IT assets. So whether that's IT infrastructure or devices like PCs. I think one area where there's a little bit of a blurred line, and we've had to make a distinction in the infrastructure and devices practice, that there's many infrastructure OEMs that I cover that are invested heavily in developing IT ops management software and platforms that automate IT processes. This software is typically used by an organization's in-house IT department or administrator rather than by a party outside of the client's organization. So I really think that outsourcing piece is what defines managed services for me. In that case where maybe XYZ organization's administrator is using HP's GreenLake IT ops management, I'm not seeing that as a managed service. That's more just a software offering from HPE.
Well, and I'll hop in next. I think from the cloud perspective, one of the interesting things about managed services, it really feels like that final like the big shift from on-premise to the cloud was all about getting rid of the box and being able to outsource where that compute was. And managed services bring that final leg to get rid of the need to, as Ben mentioned, manage the operations, monitoring, the optimization, even security of these cloud environments. So it's taking rid of this responsibility of not only having the hardware on-prem, but having to manage cloud resources that the enterprise is using to manage their workflows and drive digital transformation.
Excellent. And I'll just say from the start, if you have questions, go ahead and drop them into the Q&A. We will take questions at the end as well, of course, but as we're going along, we can address questions that come in. With that, I'll turn it over to Ben to walk us through what we're going to talk about first.
Great. So first, we'll discuss the evolution of the commercial model. The managed services market of today looks much different than the managed services market of past years. This is due in large part to the acceleration of public cloud adoption, which was spurred by the onset of the pandemic. You have workforces being increasingly distributed and a growing number of organizations now operating hybrid IT environments. And this increasing IT complexity is ultimately driven a widening of the skills gap and growing appetite for managed services. I think at the same time, organizations' managed services expectations are changing as are their overall IT procurement strategies, and this is really the core driver of the evolving commercial model. But for managed services, instead of paying for hours of outsourced labor, organizations increasingly want to pay for outcomes. I think this is a theme that you'll see from some of the other presenters today. Additionally, IT buyers are becoming more accustomed to the as-a-service model, and technology companies are aspiring to grow their recurring revenue bases, drive smoother, more predictable quarterly results. And this is an initiative supported by managed services growth, as well as other changes to the commercial model. So double-clicking into the OEM and the VAR perspective, many infrastructure OEMs and device OEMs have added consumption-based pricing models and all-in subscription offerings to their portfolios that were once transacted primarily through cash purchases. However, while financing has long been an option, these all-in subscription offerings typically bundle services like support and asset monitoring and management together with hardware to drive total deal size. However, while OpEx-based infrastructure consumption is becoming increasingly popular, if you refer to the chart on the right side of the slide, we can see that TBR survey data shows that most organizations, regardless of their size, continue to prefer CapEx-based purchasing methods. Nonetheless, TBR hears in conversations that we have with sellers that by discussing all-in subscription offerings with prospective customers, sellers often find it easier to attach other services to the deal, including managed services, even when a customer chooses to procure IT assets in a traditional CapEx method. On the other hand, changing the way sellers sell is a costly endeavor, which requires OEMs to invest in internal sales and channel training, as well as increased incentives for subscription sales and traditional sales, which is something that we see from OEMs across the industry. Well, the addition of subscription offerings to OEMs' portfolios remains an area of investment. Both OEMs and VARs also seek to sell discrete managed services to customers who prefer that CapEx procurement method. Here, the proliferation of hybrid IT architectures across organizations of all kinds has presented an opportunity for OEMs and VARs to develop IT ops management platforms that support both fully and co-managed IT. Fully managed IT presents the greatest revenue opportunity for OEMs and VARs, but many organizations opt for co-managed IT, combining the benefits of both outsourced IT management and in-house IT administration for flexibility and cost optimization reasons. Thus far, storage as a service has emerged as the most popular hardware-tied subscription offering from OEMs, allowing for the flexible scaling of storage resources and reducing storage management burdens on in-house IT. Many storage as a service platforms also address challenges with siloed data, creating a virtually unified storage environment for organizations. In storage as a service, much like other types of infrastructure as a service from the box providers, OEMs differentiate their offerings through service level agreements. These agreements not only outline levels of performance, capacity, and availability, but are also now including new components, with Pure Storage recently introducing the industry's first energy efficiency SLA. Additionally, as customers' preferences evolve, an increasing number of OEMs and VARs are negotiating custom KPI-based pricing agreements to win deals. However, for these storage as a service deals to truly be considered managed services, through my lens, there must be an outsourced monitoring or management component. That's not always the case. In summary, the introduction of hardware consumption services has changed the way OEMs and VARs go to market, allowing for easier bundling of hardware leases, software, and services, including the outsourced asset monitoring, management, and patch updates that comprise managed services. Offering varying levels of IT management and custom KPI-based pricing models underscores the idea that OEMs and VARs would rather have a slice of the pie than no pie at all, which is something that you'll see as a recurring theme for my industry group throughout today's discussion.
Excellent, thank you. And when we turn to the GSIs and the consultancies, what you actually see here on this slide is one of the most recent bubble charts, TBR classic bubble chart of the IT services space. And of course, IT services has long had outsourcing or managed services as a critical component of IT services revenues. But what's been interesting in the last few years is how much the management consultancies and more consultancy or consulting focused IT services companies have invested in and expanded on their managed services offerings. And it's been for a few different reasons. And actually one of the things that Ben mentioned was the change in procurement strategies and outcomes-based pricing. Both of those things have certainly influenced the way that IT services companies and consultancies think about improving their managed services offerings and making those managed services offerings a critical, reliable, and long-term and predictable revenue stream. That part of it has been a major driver in how managed services has become strategic for a lot of these companies that maybe in the past it wasn't. The challenges, though, then come because it is difficult to do this, particularly outcomes-based pricing. The question is who takes on the risk. The question, of course, with outcomes-based pricing starts with what exactly is the outcome. One other thing I want to point on here that's in the middle there is the consulting pull-through. What we've traditionally seen in the consulting space and in the consulting-led IT services space is exactly that, consulting-led. The traditional approach was to provide consulting, to provide the what should I do and the help me do it, and then that would lead to the do it for me revenue or do it for me engagements. Instead, what we're seeing is a lot of consultancies and even IT services companies realizing that their managed services engagements can uncover consulting opportunities at the other end of the spectrum. So we're seeing the Deloittes of the world, the Accentures of the world, even the Infosys, the TCSs of the world, using their managed services engagements as a way to unlock other consulting opportunities. That's kind of a complete 180 from the way things used to be. And then we're also seeing a change in the way that they think about things like IT asset management, FinOps, tax, and even cyber as being long-tail managed services engagements that, again, provide that reliable revenue stream and that consistency that a lot of these companies need, particularly as their consulting revenues are under so much pressure. With that, I'll turn to Alex.
Thanks, Patrick. I think the commercialization conversation that I think a lot of it is very important to the hyperscalers. Obviously, with the benefit of the as a service, this is a trend that they've given as part of their go-to-market has been innovative with driving through those systems. I think when you start talking about outcome-based pricing, it's something that's a little bit different of a conversation. With the way that we get a lot, a little bit of conversation. When we talk about AI ops, I think it's always part of the conversation, but as far as writing these directly into SLAs, it's something that's been a little bit more of a laggard in some regards, opting to kind of maintain the status quo with the consumption pricing model. I think long term, I see AI broadly as being an area where outcome-based pricing is something that the hyperscalers have on their mind. Right now, there's a bit of a cost constraint around the pricing flexibility that these vendors have, and sort of bringing these these emerging AI tools to market. But when we think about the value being derived and kind of focusing on the ROI calculation that customers want to see within AI adoption, focusing on that outcome is something that is appealing. It's something that's being explored. I will say that I think the biggest difference for commercialization for the hyperscalers is just this growing interest in native managed services. Obviously, this creates some competitive friction with managed services pure plays, but overwhelming, I would say that the partner-led strategy is what is the default and de facto. But the hyperscalers are looking for specific opportunities where they can, be able to offer these tools natively. Security is a big one, cloud operations. A lot of this is going to be tied to the AI ops capabilities that they're developing, looking for ways where how can we automate cloud management, endpoint security, and anomaly detection. These tools that are can be sort of outsourced to the software layer and have sort of a lower manual labor component are typically the ones that the hyperscaler is looking at the most. So this is a bit of a change. This is something that has some nuance across the hyperscalers. I would say that Amazon has always been a vendor that has been early in offering their managed services, whereas Microsoft has been more partner-oriented for longer. But the big takeaway is that even as this sort of limited encroachment starts to rise, the overwhelming feeling within the hyperscalers is dependence on the partner ecosystem. And I think that that is a pretty good segue into our next topic, which is going to be multi-vendor collaboration. So when we think about managed services and the hyperscalers, the big three benefits to them is the ability to deliver at scale. So the managed services resources that these hyperscalers have, they're still limited in size. And so when we look at the breadth of the ecosystems, it's just not comparable. And they're always going to rely on partners to be able to bring these at a global level. And when we talk about global level too, I think that's an important differentiator because we talk about localizing these solutions for global clients, whether that be in a regulated industry like the EU, APAC, where there's data residency and solutions that need to be sort of tailored around the geography. So looking at that localization is something that the hyperscalers are going to continue to rely on their partners for. The other piece of this is the verticalization. So being able to take cloud services and build on top for vertical use cases is something that is a main part of the managed services ecosystem for these hyperscalers. Industry expertise has never been a strong suit for the hyperscalers. I would say that they're improving their vertical product strategy, but it's still something where the client is going to be better served going through the partner ecosystem. Obviously, with AI ops and managed services revenue growth, these are disruptors, and it kind of shifts the value within the ecosystem up to these more specialized tasks like vertical solutions. And I do see that the value of things like cloud operations becoming more table stakes and pushing the value sort of up the stack. But overwhelmingly, there's a really strong need for a strong partner environment. And this continues to increase, to drive increases in investment into the partner ecosystem. At the Ignite 2024, one of the things that I took away was looking at the priorities for Microsoft. 3 of the 5 for partners all touched managed services. And when we looked at the rise in investment into each of those priorities, it was pretty astounding. Double-digit increases kind of across the board when we talk about investment into the managed services ecosystem. So it's something that they're putting money into, either through partner incentives, but also customer incentives. And the one last thing that I'll talk about is just the marketplace visibility. Bringing listings for managed services offered by partners to the cloud marketplace is something that is pretty ubiquitous. AWS, they just made a big change in giving its own dedicated directory within the AWS marketplace to managed services. So continuing to refine the marketplace to improve visibility in managed services is something that the hyperscalers are doing. And so this goes to show the focus that hyperscalers, despite their own initiatives within the managed services market, the impetus and the fact that the partner delivered model is still the default. With that, I'll be handing it over to Patrick to kind of go a little bit deeper onto the services side.
Yeah, and to me, the most important numbers on this slide, and for me, I'm going to confess maybe the most important numbers in this presentation are the 1747.83 that you see here. And that is from research that Informatica itself did into their own go-to-market results. And they found when they went to market by themselves, they won 17% of the time. When they went with one partner, they won 47% of the time. And when they went with more than one partner, they won 83% of the time. As you can imagine, when those results were shared with the board, there was a pretty easy decision to say, okay, we're never going to market by ourselves ever again. And I think that really reflects the way that the ecosystem has changed for everyone, and including for me, for the consultancies and the IT services vendors. Of course, there's challenges with multi-party engagements. There's challenges with going to enterprises with a multi-party team. From the consultancies and the GSIs perspective, of course, that starts with a long history of being technology agnostic. That is, they will work with any technology provider, whoever the enterprise client wants to work with or is already working with. That's great in theory. In practice, it's never actually been the case. And what we're seeing increasingly is so many of the IT services companies and the consultancies having, rather than not picking favorites, they're absolutely picking favorites and deciding who they want to go to market with and forgetting the technology agnosticism. A second challenge, of course, is around co-opetition. There's a lot of overlap, or can be a lot of overlap, in services. We'll actually touch on this because one of the questions gets at this that we've got in the Q&A. There's definitely times when there is overlap, and so how do you ensure that you're not competing with your partner as you're going to, or your multiple partners as you're going to market? So what is it that will overcome these challenges? Why do we think that the multi-party is absolutely the future of IT services and consulting and technology? It's because clients are demanding it. Clients are looking at their IT services companies and their consultancies and saying, you guys are all basically the same. The technology is all basically the same. It's the relationship that you have with each other that can bring me the most innovation. It can bring me the best price, me as the client. And so they want to see those multi-party alliances coming to the table with solutions for them. And then the other reason that it's sort of irresistible is that 83% number right above. That's really hard to ignore. One more thing about partnerships and ecosystems while we're on it. I just wanted to share this. It's a view of two different reports that we put out. On the left is a snapshot from the Cloud Ecosystem Report that looks at about a dozen IT services companies and obviously Deloitte. And it looks at the Azure, AWS, and Google Cloud relationships that they have, and we break down all their numbers and we look at their headcount, certified headcount, and all that. And of course, we examine the strategies and the business models behind it. And then on the right, you see a piece from our Voice of the Partner research, where we go out and both survey and then do in-depth interviews with alliance directors and above, or people responsible for alliance relationships at OEMs, at cloud and software vendors, and at IT service companies and consultancies, trying to understand what it is that they are looking for from each other so we can better understand, again, that multi-party ecosystem. And with that, we will talk briefly about some leaders and laggards and emerging disruptors, because at the end of the day, technology business research, we are looking at individual companies and thinking about what is their business model, what is their strategy, what is their financial performance, and do those three things go together? And if so, how do they stack up against others in their peers or other in their peer group? Again, you're looking here at the bubble chart from the most recent IT services benchmark. Actually, I'm not even sure this one was published yet, but in any case, you get to see it now. And you can go in here and pick out exactly who you think a leader and laggard might be. Obviously, heading to the right, it's all about revenue growth. Going up, it's all about operating margin. And the size of the bubble is the size of their revenue. I'd call out two in particular who I think are going to do well going forward from the managed services perspective, since this is a managed services focused discussion. And those two are three, Accenture, Deloitte, and NTT. Accenture typically leads in a lot of categories. They tend to be a bellwether company in the IT services and consulting space for all the reasons that we all know, including their massive size of around 800,000 plus people. But they continue to adjust their strategy and adjust their go-to-market in ways that, again, everyone else ends up playing catch-up to what Accenture is doing. Even when they have a bad quarter, what we tend to see are the investments that they're making and the acquisitions that they're making that position them for the next wave of opportunities that is coming. Deloitte, of course, has increasingly become more and more like Accenture over the last few years. In fact, it's sometimes hard to remember that they're actually part of the Big Four. They're not just like Accenture and like the Capgemini and Atos and the smaller versions of Accenture that are out there as well. Deloitte, of course, has been investing heavily in their ability to deliver across the wide range of services that they provide, not just audit and tax, of course, but we're looking at the consulting side of the house for Deloitte, and they continue to grow and outpace their peers. I think that's going to continue. They have invested more in managed services than any of their Big Four peers, and we think those investments are certainly going to pay off going forward. I'd also call out NTT simply for the size of NTT. they have the scale and the capability to take advantage of these trends that we've been talking about in managed services, as well as Accenture, as well as probably anyone else in this particular bubble chart and in the space that we look at with respect to IT services. And then when it comes to laggards, I'm not going to name names. I'll just say the two things that we think that we're looking at as signs that a company is starting to fall behind. One is a lack of a coherent technology alliance strategy. That is, they're continuing to be technology agnostic. They're continuing to let the technology companies determine where they go, rather than finding the right partnerships, rather than starting the kind of alliances that can drive growth. And then secondly, not having a coherent technology strategy. Those two things are actually different. One is about alliances, and the other is about what technology they're actually bringing to their clients. There's no service now that isn't fully permeated by technology offerings. And so the companies that we look at that have not figured that out yet are the ones that we think are going to be lagging. When it comes to disruptors, I'd actually look at the India-centrics, and that might be surprising, especially in the managed services context. But I think the India-centric companies, so that's in this particular view, it's Wipro, TCS, Infosys, HCL Tech, Cognizant, those companies, Tech Mahindra as well, those companies are probably under the most pressure with the advent of AI or the rapid adoption of AI to both change their business models and their staffing models in particular. And anytime a company is under a lot of pressure from outside forces, they tend to become disruptive or they go away. I think we're probably going to see more disruption than these companies disappearing. I'd keep a close eye on HCL Tech. I think they're probably the most nimble of those IT services, India-centric IT services companies. And with that, I will hand it over to who goes next. Ben.
I'll go. So quickly, I wanted to address one question in the chat here. It kind of touches on that partnership topic we mentioned a second ago. The question is, are you seeing growth in the channel adoption of subscription models from OEMs, or the channel remaining a cash and financing space? So the channel definitely remains cash and financing space, although we see more and more OEM investments into incentivizing sales of subscription or based solutions. I think one area where I see one OEM differentiated from the rest is really with HPE, and they're allowing certain partners to sell their own third-party managed services through the GreenLink platform. So I see that as a differentiator. And then just quickly moving on to leaders and laggards, I'll talk more about from a strategic perspective. I think right now we see a lot of AI infrastructure-driven demand, and there's kind of two camps where all major infrastructure OEMs have these joint solution portfolios that build on NVIDIA's AI enterprise software platform, create some of these pre-validated and customizable solutions for enterprises. However, we know that the AI infrastructure demand, at least thus far, has really been driven by cloud service providers and model builders who aren't really interested in those kind of pre-validated solutions. I think right now we're seeing some OEMs stay true to kind of that more hybrid AI, wanting to build a solution for the enterprise, knowing that enterprise is really the sweet spot for OEMs. And then I see other OEMs taking advantage of the near-term opportunity of selling to these cloud service providers. And I think the companies that stay more true to selling to enterprises, those are the companies, the OEMs that are going to benefit most from managed services growth going forward. And then lastly, just to touch on VARs, they serve a little bit different segment of the market. They're more mid-market players. I think they own that space. I know that VARs really have trouble moving up value chain. So I think in the mid-market that VARs will continue to do well in services there, just as long as we don't push up too close to the enterprise.
Cool. Thanks, Ben. And for the hyperscalers, I think that broadly the hyperscalers go forward to understand the importance of managed services, whether that be their backdoor more faster growing channels for the hyperscalers, all investing to make sure that the offers are available for their cloud services. So I think where the differences start to emerge is in how they are approaching. We look at direct revenue from managed services offerings by hyperscaler. AWS is more than double its closest peer. So in the rest of the group is really kind of at a similar level. So you kind of have AWS kind of alone as a leader in sort of offering it directly. But what I do think that they give up is for that overall ecosystem. Microsoft is a vendor that I think has been partner-led and partner-first for a long time, whereas AWS has been more willing and more desiring to sort of find the customer. And that might be sort of a drastic generalization. I would say AWS is partner-oriented, but just kind of looking at the nuance between the two, the scale of Microsoft's ecosystem does have a bit of a leg up. So, overall, it's sort of gives and takes, but when you look at the nuances, that's where the differentiation really comes into being for the hyperscalers.
Excellent. And I think just to wrap it up, we could go around and ask each other sort of what stands out most about this, but what each other said. But instead, I think we'll take some of the questions. I'm going to blend two of them together because one is how important is security add-ons for managed services offer? Should it be the base offer for managed services? And another question that came in was, what is the status of Microsoft Security Experts MSS offering? Is Microsoft expanding this? Alex, if you want to take the first one and I can weigh a little bit on the second one, I'll weigh a little bit on the first one. They do kind of blend together.
Yeah, I mean, so when we do our cloud customer research, security is always at the top. So when we think about managed services for security, this is something that is a top cloud pain point. We also in our research, we find that customers expect the cloud vendor and their partners to be able to kind of cover their security footprint. So there is this customer instinct to look towards the providers for SecOps. So it is something that I think is a massive part of the conversation by default. As far as Microsoft, when I think about where all the hyperscalers, so really actually Microsoft, Google, and AWS, security is probably one of the biggest areas that they're increasing resources for managed services.
Yeah, and I'd add from my perspective that the largest GSIs have been, of course, offering cyber managed services for a long time. The consultancies, I think of the big four firms, have as well, but at a different kind of scale. And I think as managed services become more important for those companies, cyber managed services is both an important revenue stream, but it's also a really important use case. It's their own way of saying internally, this is how to run a managed services operation based on what they've been doing in cyber managed services for a long time. So I think, is it important as an add-on? I think it's more important as something that you continue to evolve, you continue to adopt new practices, but most importantly, use it as the way of showing, as sort of the test bed or the customer zero, the way of showing that you've already done this before. You can add additional managed services capabilities built on the lessons learned around cyber. Because again, for a lot of these companies, as they're expanding their managed services capabilities, they're running into those challenges that I mentioned before around outcomes-based, around the challenge of co-opetition, around the challenge of partnering across the managed services space. Another question that came in, how does the expansion of native managed services by hyperscalers impact MSPs, businesses, and what are the opportunities for partners? So this question has been coming up for as long as I've been doing competitive intelligence and intelligence generally in the business space. And so that's more than a couple decades now. And it is always the fear that one of the technology players is going to develop services capabilities, professional services capabilities, or managed services capabilities that eat away at the GSIs, at the consultancies. And at the end of the day, it's never an existential threat because services is both harder to do than it looks, and also frequently a lower margin than the hyperscalers themselves can get by doing what they do well. So while the hyperscalers will always be able to provide those additional value-added and probably higher value-added managed services and IT services that are attached directly to their own technologies, there's always going to be the role for the GSIs and for the consultancies to do, as Ben mentioned earlier around industry, as Alex is mentioning around specialized capabilities that the IT services and consultancies bring to the table. So we're always going to see a fear around the expansion of native managed services and other services by hyperscalers, but that fear is always going to be sort of a little more fear than reality, and we don't see it being, again, an existential threat. There's a huge opening, of course, for the companies that can manage that well and partner well with the services, including managed services components of the hyperscalers. The challenge there, of course, is both around the commercial model and, as I mentioned before, that co-opetition where they're looking at their own offerings and ensuring that there isn't any kind of conflict. Last question before we wrap up is, are the trends that we're seeing consistent across the globe, or are you seeing different behaviors in different regions? The one thing that I'll go first and just say, I know we've seen when it comes to outcomes-based pricing, it is much more prevalent in the US than anywhere else. I was in Singapore earlier this month. This topic came up quite a bit. We're not seeing the same appetite for outcomes-based pricing in APAC. But that said, it is probably the one area that is most ripe for change within the commercial models of everybody that we've been talking with. I'm actually looking at our whiteboard right now where we're sort of predicting by 2030 what the different percentages of engagements are going to be in terms of the pricing. And outcomes-based pricing, we have it only around plus or minus 10%, but we also look at all the different ways of evaluating what is outcomes-based pricing, who sets the outcome, what's the term for it, what are the penalties and what are the risks, and we realize that it's probably moving more towards outcomes-based pricing than we think. But to answer the question, to come back to the question again, that's one of the biggest differences I see regionally. Do you gentlemen have any other differences that you see regionally when it comes to managed services?
I think that when we start talking about data residency regulations in the EU and the APAC region, that drives different sort of opportunities and managed services opportunities there are going to be, kind of defined by some of that. So, I think that it's very similar delivery, but just sort of use cases and problems being attacked. That's where the variation globally comes into play.
Excellent. And then I guess there's one last question, and we'll go ahead and take it. With the advent of AI, there's been talk on the possibility of dark network operations centers, operations optimization, intelligent operations. What trends do you see in this area? Ben, I'll go to you first. has AI created a trend towards dark factories as well? But from the OEM perspective, can you imagine them actually producing infrastructure, both products and then services and managed services, in a way that the human is completely out of the loop? Is that coming soon?
I think there's a lot of automation being added to IT ops management platforms. I don't think that right now I can clearly envision a time when there's a dark data center. There's absolutely nobody involved in running it from a human perspective, but I'm sure other people in the industry have different ideas, maybe including Jensen, but I think that would be years and years away.
Alex, your thoughts on it?
I completely agree. I think that AI has a lot of promise long term, and we talk about this technology in decades. Who knows where we end up, but I think that we're sitting in a position right now in this hype cycle where the near-term expectations are a bit elevated, and a lot of the market opportunities that exist today are going to see limited impacts, no matter how transformational the technology ends up being over the long term. So